Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Sonja Marten joins us. She's head of FX and monetary policy at DZ Bank, and she joins us here. Sonja, thank you so much for joining us here. Is there a bearish call for this U.S. dollar anywhere in sight?
Not really, to be honest. I think it's a bit of a one-way street for the time being. I'm hoping we're going to get a bit of a breather over the holidays season. So if we're lucky, markets are now in a sort of wait and see stance. You know, there's been a lot of news to digest from the Trump election, but now it's kind of time to see what's going to happen once he actually moves into the Oval Office again. So maybe we're going to get a bit of a breather. I don't really think that Eurodollar has a chance to really rise here. It's too much positive news for the US dollar in the pipeline, and really, frankly speaking, also too many bad news for the euro in the pipeline. So I still think we're heading down in Eurodollar.
So when you're looking specifically at the Bloomberg dollar spot index, I mean, it's fallen to levels roughly around 2 weeks ago, but we've still seen dollar strength in the last couple of weeks too. So when you're talking about, especially the Trump administration coming in, particularly if they end up going harder, faster on tariffs, what are the scenarios for the US dollar?
Well, I think looking at the first 3, maybe 6 months of the new presidency, we're probably going to look at a stronger dollar, because what's going to happen is Trump is going to start talking about tariffs. And what that means is more inflation. I mean, I know that a lot of the Trump voters don't understand that they're the ones who are going to end up paying for those tariffs, but they will end up paying for them. And if Trump comes through on his promise to levy 25% on import goods from Mexico, the Americans will be paying a lot of money for their cars. So this is inflationary, and that means that the window for the Fed to cut rates will be closing soon. And this is all dollar positive. And of course, then we also have a strong growth boost from tax cuts. So all that combines to make a strong dollar. I think further down the line, there are risks to the dollar, but they're not going to matter so much in the first half of next year.
Sonja, what are the currency markets telling you about Federal Reserve policy decisions here? Does the currency markets, are they pricing in more Fed rate cuts?
It's less. I mean, it has sort of become less since the Trump election victory, because, you know, there is that window of opportunity that's going to be closing. Right now, we're having a debate in the market about whether they should be cutting in December at all, which I think they should, because their window is still open. This is the time to do it, because that window will close. So they will be cutting, and I think the market is sort of adjusting to having them cut less for less long. So we're looking at, you know, the spring of 2025, and that'll probably be it. And so this is interesting because a lot of other central banks will still be in the middle of their rate cut cycle. So it's going to open up a bit of a divergence when you look at monetary policy next year.
It's interesting, too, because like you were saying, you have other central banks in the middle of cutting cycles. But then when you think about the Bank of Japan, completely on a different course, just given their economy and just looking at the yen, I mean, that was breaching the 150 level earlier, especially when you're thinking about what that means with the latest inflation data in Japan as well, and especially boosting some of the likelihood that the Bank of Japan will continue to raise rates, especially when it comes to that meeting in December. So give us kind of the dynamics between when you're looking at the dollar versus, say, what's happening with the yen, because we've seen that really track closely with S&P 500 futures.
Well, I think the yen is probably one of the few currencies that has an opportunity here to beat the dollar next year. And that is simply because the BOJ has really changed its course. I mean, the rate hikes will come, further rate hikes will come, but in the grand scheme of things, what really matters is that the Bank of Japan is, you know, proceeding with its quantitative tightening. They're reducing their balance sheet. It's a big balance sheet. It's a lot of reducing to be done. And that is really going to make the difference, I think, for the currency market. So we're looking at dollar yen to fall, maybe less aggressively than it might have had Harris won the election, but it will fall. So yen will rise against the euro. So you look at the dollar yen against the 2-year yield spread or the 10-year yield spread, you can see there as well, there is a close correlation, and that's definitely pointing for your dollar yen to fall.
The European Central Bank has been cutting rates. The expectation is they will continue to cut rates. To what degree do you think the ECB will be dovish here going forward, and what does that mean for currencies?
Well, I think the ECB has every reason to be quite dovish. I mean, there's currently speculation whether they might cut rates by 50 basis points at the next meeting. Again, I I'm not a big fan of that speculation. The ECB has reasons to cut. They can send a dovish message and basically tell the market we'll continue to cut 25 basis points at every meeting. I don't really see the need to do 50 simply because there are still inflationary concerns lingering in the background. And, doing 25 and sending a dovish signal seems to me a safer course of action. I think the interesting thing with the ECB will be that once the Fed stops cutting in late spring, the ECB will continue. And I think they'll probably end up cutting rates at least throughout the summer into the autumn of 2025. And that's negative for Eurodollar as well.
Which currencies do you think will be most affected and most vulnerable to trade tensions with the U.S., depending on what happens with tariffs?
Well, I mean, the euro is obviously one big candidate, but the problem is there are currencies that are affected, on various levels. So you look at, for example, Eastern European currencies, right? I mean, for them, the growth slowdown in Germany is going to be a big problem. We have central banks that are cutting rates quite aggressively as well. A Mexican peso obviously is a candidate for losses, and despite its current surprising, I think, resilience. But Trump isn't in office yet, so there's more to come on that front. Then you have countries where you get the double whammy impact of slower growth in Europe, maybe also slower growth in China. So it's I think for many currencies going to be a very challenging year, and there will be a number of currencies that will actually underperform an already weak euro.
So Sonja, just kind of given that economic backdrop, where do you see the best value out there in the currency markets?
Well, I think, again, very few that are really interesting. I think, again, Japan, bit of a timing issue with Japan. Obviously, we've seen last year that it can go horribly wrong when the BOJ did its turnaround. The market kind of didn't react very much, and then we had this speculative attack on the yen. But I like the yen. I like Australia, New Zealand. The Aussies are not in any rush to cut rates. They will be cutting rates next year, but in a much later than anyone else. I quite like New Zealand. The economy is going to look quite strong in the second half of the year. But to be honest, after that, the ground gets pretty thin.
Excellent. Sonja, thank you so much. We appreciate that. Sonja Marten, she's the head of FX and monetary policy at DZ Bank over there in Germany.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Aneeka Gupta joins us. She's a director of Macroeconomic Research, Equities and Commodities at WisdomTree. She is based in London. Aneeka, thanks so much for joining us here. Can we step back and can you give us a sense of just how the European economy is playing out these days?
Yes, Paul, like you mentioned, the story here in Europe is very different to what we've been witnessing in the US. Just this week, we've had, much weaker release of PMI data. What surprised me was not only manufacturing was weak, which has been, a theme over this past year, but we've also seen weakness in the services PMI data. Now, for Europe, which is, again, very different to the US, the European consumer has actually been a big saver. So while US consumers have been eroding their savings, European consumers have been hoarding their savings. And that remains a key question mark of, could we reach a point where the European consumer starts to spend, and that could be the new catalyst. However, what we're also seeing is, consumer confidence numbers across European consumers remain very weak. And so that catalyst is unlikely to be triggered or, yield any tailwinds for the European economy because the confidence just isn't there. So unlike the US, where you continue to see very strong spending by the consumer and that's supporting the economy, it's a very different picture here. And it's unlikely to change until we see, some stability in the economic as well as the political front.
And when you're talking about the economic front too, just the latest data on the Eurozone seeing inflation accelerating beyond when you're thinking about the ECB's 2% target, similar to obviously the Federal Reserve's goal as well. What does that mean for ECB cuts? Because looking at the swaps market, they're still anticipating that there's going to be more cuts at their next meeting next month.
That's right. The inflation numbers, give out this impression that inflation is actually much higher. But beneath the surface, you are seeing weakness continue to creep in, and that will show that, in the following quarters, we will see inflation coming down further. And that continues to feed into the narrative that the ECB is likely to remain extremely dovish. We've had very strongly opposing views just this week. We've had Isabel Schnabel tilt very hawkish, while we've had Gallau, tilt on the extreme dovish narrative, saying that, we could go as aggressive as 50, whereas Schnabel is saying, we must take a much more cautious path. The market still believes that with such a backdrop of anemic growth alongside inflation that is cooling, it just paves the way for the ECB to go ahead with a further interest rate cut. So we're likely to achieve 1.75 for the ECB policy rate by the summer of 2025.
Aneeka, earlier this month, we Americans, we elected ourselves a new president. We've got a new Republican Congress about to take office in January. How did that change maybe your outlook for just your economic forecasts across Europe, if at all?
It has a very big impact. And I think that has been the key driver of sentiment across the Eurozone economy. First and foremost, we are likely to see an escalation of tariffs, being placed on the Eurozone economy. And that just raises further uncertainty, for how trade is likely to be impacted, owing to the impact of tariffs. One saving factor has been the euro, which continues to remain weak. And obviously, with the ECB doing much of the heavy lifting, the euro is likely to remain even weaker, which will provide a bit of a catalyst for the exporters, but not enough to outweigh weaker demand alongside the impact of higher tariffs.
And when we talk about an escalation potentially when it comes to those tariff threats, what products in particular, or if you're thinking about more across industries, could be most impacted in Europe and then end up being more expensive for consumers?
Absolutely. It's, a lot of the consumer discretionary names, the well-known, companies that are exporting in the luxury sector, they're likely to be impacted. The auto industry, which remains key for Germany, as well as France, these companies are also likely to come under severe threat. And that remains the overarching concern for the Eurozone economy. It's so dependent on exports, even more in comparison to Japan. And a weaker euro is not enough to offset the weakening demand backdrop alongside this impact of higher tariffs.
Gold. What do you think about gold here, Aneeka?
We still like gold. I know that we've had an immense cooling in prices, but you have to keep in mind we've had a very sharp, strong rally in gold. Geopolitical risks, if anything, have not gone away. I know that President-elect Trump has claimed that he will end the war, but if the observations that I'm noticing are, if anything, we've had a ramp up of the war between Russia and Ukraine. And we're also seeing tensions in the Middle East escalate. There is, a ceasefire being called, but they are contingent on a number of conditions, which if, any of the two parties violate, it will result in extreme escalation of those tensions. So that remains a key support factor for gold. The second big one will be physical buying by the central banks. That remains, front and center. ETF buying in gold-oriented ETCs has resumed, remains very strong in China as well as Europe. And I think those will be the structural drivers for gold going forward.
What about when it comes to the 10-year Treasury yield? The low in September was around 3.6. Right now it's around 4.2. And of course, the high this year was around 4.7. And what do you think is most important for traders in those levels as far as those thresholds mean for resistance as well as support?
Yeah, I mean, it really all boils down to the U.S. elections and the results of the U.S. elections. I mean, since we've seen Trump taking power, most of his mandate is extremely inflationary, and that just tells us that yields are likely to remain higher for longer. The expansion of fiscal policy again points in the direction of yields remaining higher for longer. And that just tells us that, the expectation of Fed rate cuts have now declined. And at the same time, we're likely to have Treasury yields remaining high, and that could pressure equities going into 2025.
Aneeka, thank you so much. We appreciate that. Aneeka Gupta, she's the director of Macroeconomic Research, Equities and Commodities Group over there at WisdomTree. She is based in London. We appreciate getting a few minutes of her time.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
You know, the economic data, Jesse, the macroeconomic data that we see on ECO Go that we use all the time. I mean, GDP's pretty darn solid. Inflation coming down, maybe not where the Fed exactly wants it, but coming down. The retail sales numbers can seem
still
to
strong.
be pretty
Consumer.
darn strong. But you still get that sense that that K-shaped economy is still out there. Not everyone is participating, and it kind of begs the question, how are the small businesses doing out there in the U.S. economy? Gene Marks can help us out on that. Gene Marks is the founder of the Marks Group. Hey, Gene, talk to us about kind of your clients, your small business owners. How are they doing out there?
First of all, good morning. And I can tell you that small businesses themselves, when you try to talk about their, how they're generally doing, it's a little tough to generalize only because there's 33 million small businesses. Wow. Guys, I mean, there's, all across the country, the businesses themselves make up half of our GDP, half of our employees. When I, survey my clients and my readers and my community, kind of depends on the industry that they're in, or it depends on the region that they're in. I mean, some are stronger than others. But if you want to do like just a general take, I would say that 2024 has been a challenging year for most small businesses. I just did a piece for the Philadelphia Inquirer, and I interviewed about a dozen small businesses in the Philadelphia area, retailers, distributors, whatnot, how they were preparing for the holiday season and how 2024 has been very very anecdotal. And every single one of them across the board had said that they were hoping that the holidays were going to be saving them this year because they have been struggling. So again, tough to generalize because again, some businesses have done better than others. But if you were to do that for the 30 plus million small businesses, I would sum up 2024 as a challenging year. Also, one final thing, I wrote a piece for The Hill where I summed up a bunch of surveys that were taken by Bank of America and Verizon and other places for the National Federation of Independent Businesses. Those surveys also found the same thing. Revenues themselves were flat or even a little bit down, and profits themselves were also flat among those surveys. And this is through September 30th of 2024. So I hope that gives you some indication as to where their heads are at right now.
To your point, Jim, when it comes to those small businesses, they're typically highly indebted and also really sensitive to higher interest rates. So especially over the past few years, as the Fed was really aggressive with raising borrowing costs, they were obviously more reliant on kind of cheap labor as well, in addition to what's happening when you think about rate cuts potentially relieving them. But also, we might not see as aggressive rate cuts next year. But also, the other caveat, too, when you have smaller companies that are more dependent on cheaper labor, how will mass deportations from the Trump administration end up affecting small businesses to that end?
That's a great question, Jess. And I get asked that question a lot about mass deportation. So, my understanding is, and you guys correct me if you think this is wrong, but the idea between the Trump administration's mass deportation is to deport illegal or undocumented immigrants. So when you look at it at face value, that should have no impact on small businesses, because why would small businesses be hiring illegal or undocumented people, right? So, on the one hand, you have some small businesses that are making sure they're doing what they need to do among the law, and they are not hiring undocumented immigrants. And most of my clients are that way. But then you do have some small businesses that are practicing that. I'm not quite sure, what the impact will be on them. And I'm not quite sure that most of us who are complying with the law care what the impact would be on those businesses, because if they are hiring undocumented or illegal people that tend to be deported, again, they were breaking the law from the very beginning, and they're going to have to start getting legal if they want to compete fairly. So, that's the impact that I see for those clients of mine that are complying with the law and making sure that their employees have the right documentation. They're not going to see any impact from this, type of thing. But for those companies that have not been complying with the law, yeah, they'll be impacted by it. But then again, maybe they should be impacted by it if they're hiring people that don't have the right documentation.
Another aspect of the incoming Trump administration, at least at this point in terms of speculation, is potentially lower taxes. Give us a sense of what I got to think that's going to be good for the small business owner. How big of an issue is that?
Massive. So I've been if you haven't figured it out, and for any of you guys watching me on YouTube, I'm actually a certified public accountant. So that should come as no surprise to anybody when you look at this face. So taxes has been a big issue for us this year. And next year is going to be a tax Armageddon. I mean, there's going to be such a huge change in taxes that impacts small businesses and all of us individually. For the small business owner, there is one giant, well, there are a few, but there's one giant tax deduction that is hopefully going to be preserved. It's the qualified business income tax deduction. That's where if you run a pass-through business, most businesses are pass-through, which means they're an S corporation or a partnership. So whatever money you make at the business level passes through to your individual tax return. Well, right now, because of the 2017 Tax Cuts and Jobs Act, we get to deduct 20% of that income before it hits our personal return. So if I make $1,000 this year, only $800 gets taxed at the individual level. That provision is expected to expire at the end of 2025. It's going to have a huge impact on the small businesses that have enjoyed that deduction since 2017. Now with President-elect Trump coming into office and hopefully with congressional backing, he'll have the ability to either extend or make that deduction permanent. That will have a huge impact on many small businesses. Other deductions for research and development and also for the purchase of capital equipment using bonus depreciation, those deductions have either expired already or they've been going away. They're expected to be restored 100% under the Trump administration and a GOP Congress, and that also will be a huge tax benefit to businesses. So, I have to say, during the election, when I was looking at my personal tax bill as a business owner, it would have gone up significantly if Vice President Harris had been elected. But now, the way the election turned out, I think myself and a lot of small business owners will continue to see lower taxes. And obviously, that's a huge expense for us. So the lower we can keep it, the better.
All right, we'll see who pays for it. Gene Marks, thank you so much. We appreciate it. Gene Marks, founder of the Marks Group there.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Let's check in with Anjee Solanki. She is a National Director of Retail Services for the U.S. for Colliers. Anjee, thanks so much for joining us here on this Black Friday. Just stepping back, do you think the consumer's in a position to spend here this holiday season?
Well, I'm here actually in Southern California at a shopping center in a suburban market. So I was actually quite surprised. This is not something I do on a routine basis. I think the last time I actually came to a Black Friday at 5 in the morning was about 20 years ago. I think that was Kmart. I don't remember. But nonetheless, here I am. I'm actually quite surprised. This is a line in front of Target. I think you had just mentioned it's not that long, but when I got here, Kohl's was actually opened an hour before. So Target hasn't opened yet. It opens at 6. I went into Kohl's and I was pleasantly greeted or surprised because I got a $5 Kohl's cash card and walked in and they said, I was pretty impressed with the sales. 50% off on toys. Fenty Beauty and Sephora was 30% off. So there are some really great deals right now and consumers are leaning into this.
All right. And Anjee is reporting from East Vale, California. That is east of Los Angeles, really east of Anaheim, California. So right there and showing some lines there. That's pretty cool.
Yeah, no, it definitely is. And especially because since you're on the other side of the coast from us, obviously it's still pretty early there, right before 6 a.m. So it's interesting, too, when you're talking about some of the different sales that you're seeing. How aggressive do you think some of the promotions are going to be?
Oh, I think they're going to be pretty spot on in terms of, the deep discounts. So what we're seeing is leading up to Black Friday, it was 20 to 30%. As of today, this morning, I'm seeing 40 and up to 70%. Wow. So we have a really short period of time this year, as we all know, and it's really condensed. But the consumer today is really targeted in what they're doing. So they're going out there and they are finding some of these deep discounts to really benefit because they are, budget conscious right now.
So that's kind of where I wanted to go to, Anjee. What's your view of the consumer here? The retail sales numbers we see are pretty solid. Inflation's coming down. Employment is, 4.1%, very low. Wage gains seem pretty solid. But we know that there's just this K-shaped economy out there where a lot of folks are, struggling, quite frankly. What are you seeing in the numbers?
Yeah, no, I would agree with you. But what I'm really interested in monitoring right now is these deep discounts. So what consumers doing is they're cautious, but they're very strategic in how they're buying, where they're buying, and what they're buying. So they may not be buying as much as they have in prior years, but what they are doing is they're buying fewer items, but that are very thoughtful, that they're providing to either their families or their loved ones. So I think it's much more strategic in terms of how they're going about this shopping season. The other thing I'd say is there's a lot of FOMO out there. I am really surprised. The shopping bags are still all around. Earlier this week, I went to Disney, downtown Disney, and it was just packed with shoppers buying, all the pre-Black Friday sale items. So people are still out there buying.
What specific products do you think, when you're thinking more about electronics versus apparel, where do you see people spending the most?
Yeah, definitely. I think, you're not going to see on the high-end, high price point electronics, but like the AirPods, things of that nature. Look, I just bought these. These are my first and only Meta glasses that I wanted to test out, and they were on sale. It was like, hey, if I'm going to get 30% off, might as well try it. But my point is that I think you're going to start seeing, more of the kind of the lower price point items on the electronic side, more on beauty. I would say I think people are a bit, flushed out on apparel, so not as much. I think shoes are definitely going to be on the higher end, so you're going to see a lot of people buying more on the shoe side.
Jess, we had Dana Telsley from Telsley Advisor in earlier this week, and she said the go-to item is the Birkenstock closed-toe shoe, which I immediately thought of John Tucker.
Right.
I mean, so
the top of his list along with that hammer.
Exactly.
I asked for so little.
Yeah, so Anjee, we saw when Walmart reported that they said they saw a lot of strength coming from some of their customers with incomes north of $100,000. That surprised a lot of people. So it seems like people are looking for a lot of folks are just looking for value out there.
It's all about the value game right now. It's, I would say, middle income and below, they're all out there looking for that. That I think is the name of the game, because you have to stop and think about it. For those that are, in the $100,000 range or 100,000 annual income and above, really their spend is allocated very differently. So they're going to be traveling, it's services. They're going to be looking at, actual product purchase. So, their spend is just allocated differently from others.
What about when it comes to shipping and potential product delays this year? Because you were just mentioning how there's a few shorter days ahead of the Christmas holiday.
Yeah, what's really interesting to me is just talking about shipping and delays. We've become so accustomed to getting everything immediately the minute we hit the, buy button. So I think we're going to see a surge in store. So that's our prediction, is that we're going to definitely see much more of a surge in terms of people going into stores and shopping. And hopefully for our retailers, that's a great gain, because maybe they can see an upside in a second purchase.
All right, Anjee, thanks so much for joining us. Anjee Solanki joining us there. She is at Colliers, covering the retail space. She's right now reporting outside a retail store to talk about the retail business. She's in Eastville, California, in front of a Target and Dick's Sporting Goods store.
You gotta love a Target that has palm trees.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.